Hello, Mr. Vaidyanathan.
Hi, Prakash.
Sir, I am basically not an analyst. I am a shareholder only. So my comments or questions are from that perspective. So first of all, I am worried about, let's say, this continuous provisions. You have talked about it, good. But still, I remember last quarter you said that, okay, next quarter results will be subdued, but then onward it will be pretty good. But when you said subdued, I mean, we did not expect this will be subdued. This is number one. Number two, I mean, good that you have cleaned up the books. But if we get out of, say, microfinance, we get out of infrastructure, we get out of personal, where do you see these growth items coming next? Or we will just hang around like this only? We should forget about this as a shareholder. So your comments, please.
Yes. So if you see the composition of book, if you see first of all, we are not getting out of microfinance. It's an important business for the bank because it is helping us meet many variants of private sector, and it's an important book because this was so basically like small and marginal farmer, agriculture. It meets many a weaker section and all that. So we are not getting out of this, except that we have of course tightened the norms, got it insured in a prudent basis and all that. So what I described earlier. Now, with regard to which will be the areas for growth, of course, infrastructure we announced right at the beginning 5 years ago we won't do it, and we are not doing it. So even this MEP is it's a bit of an odd thing that came, like a curveball that came towards the end, but that's that. Now, so what are we growing? We are growing 25% is the retail finance book growth, 25%. In September 23, our retail finance book was 1,04,000 crores. Today it is 1,30,000 crores. Our QoQ growth is 4%. Annualized is 16%, but YOY is 25%. Within that also, let me just share that the home loan business is growing by 20%, loan against property is growing by 20%, vehicle financing is growing by 32%, the consumer business is growing by 21%, so and the gold loan business is growing by 185%, but that's of course is coming from a very low base. So these are all growth areas for the bank. And now corporate credit is also growing. Corporate credit grew infrastructure grew by 20%. So let me just say that these are all lines of business that are growing and will grow. We don't see any reason why we should not grow by 20% next year also.
When you say vehicle finance or property and such things, you have to bear in mind that there is supposed to be a slowdown going on, and maybe the demand for all these things are likely to come down.
Well, we'll watch it carefully, and I respect your caution. But we are finding that demand is quite strong, and let me tell you that we have not relaxed any one of our credit criteria. This 20% growth in this business is coming with the current norms itself. We have not relaxed any credit score cutoffs or anything like that.
Mr. Vaidyanathan, very simple question. In 2018, when the merger with Capital First was announced, our share price was rolling in the range of about 60 around, 58 to 60. And most likely on Monday, we will hit that point again after 6 years of work. So how do you see this shareholders should take it? What do you have, any word of advice or how we should basically look at it? I know there is a lot of past and there is a lot of this, but it's still 6 years and we have done so much of capital raise, which has all gone, let's say, I don't know, so much provisions. How really do you see this?
Okay. Now for that, let me just correct the number for you so that we are quite clear about this. At the time of merger, if you were holding an IDFC bank share, the fact is that your share price was 37.6 rupees. You can please check your numbers, go and check your records on 11th of maybe 12th of December of 2018. We know the numbers. We put it out in the annual report also. It was so. Now that 37 is now say the 60s, mid 60s, and what it will be on Monday or any day. We'll see the numbers. Now let me just say that in this window, the first 4 years please note my comment very carefully, and I understand your question because from your point of view, you're right. Your share price has not moved. Actually, it's moved. Let me say from 37 to 65, but still that's what has grown. Now let me tell you that banks, as you very well know since you're a seasoned shareholder, are valued price to book. Now, on a price to book basis, the book value per share at the time of merger was 38.43. Book value per share at merger was 38.43. Now, after that, who wrote the Divan Housing loan book? I didn't do it. Who wrote the Reliance Capital loan book of 1,500 crores? I didn't do it. This management didn't do it. Which means if this management is not in this chair and anybody is running it, anybody would have to provide for it. It's not us. Who booked the Vodafone loan? We didn't do it. So what I'm trying to say is that because of all these loans, the book value per share came down to 31 rupees by March 21, from 38 to 31. And let me just tell you that had we not come with the chair and solved those accounts, God knows where would your stock should have been. And from there, from that 31, now the book value per share has come to 53. And we have raised capital all right, but we have raised capital always at a premium to the book. And therefore, the book value per share is 51. So when you lament upon the fact that our share price has not moved adequately, I request you to think what would have been the position of this bank with these 14,000 crores of loans, of which so many thousands crores were charged off, not by our mistake, and there was no CASA of 8.5%, and there was no book. So where do you think a share price should have been? So when you point out, I agree that is your expectation, but let me tell you, this is a issue. The bank is in an early stage bank. It goes through these troubles. If you really wanted a stock which has all problems solved, then go and buy a bank which is giving you 18% return on equity, which has already solved its problem for 25 years. This is an early stage bank. Now, my comment is that this bank, with great difficulty, with the work of 40,000 people of this bank, has now come to a position of strength. Our rating agencies have rated us AAA and AA plus, whether it's FD or for long-term rating. Now our CASA is 47%. Now our core operating profit is 6,000 crores, growing at 25%. So I'm saying that we have brought the bank to a good position of strength from where it was. So now from your point of view, has it gone up or not? These are the markets. These are early stage bank situations. So I do believe bank has made big progress on technology, brand, people, CASA, loan growth, deposits, retailization.
I think everything is not correct because you are talking only the numbers from the point that the merger happened. You should take it from the point when the merger was announced and you knew fully well what you are getting into. And from that point onward, if you will see that we have practically actually not made any progress. And 58 to 60, that share price I remember because I have been shareholder from 2013, not today.
Yes, please go and I would definitely request you to go and see the numbers. We'll share the screenshot with you. The share price was 37.5 in December 2018 when the time of merger was happened. Now, I'm not saying, by the way, that movement of 38 or 37 rupees to 58 is a great job, but it's also a fact that during this window, the banking system did not get re-rated. You can see there were many other banks who, if you check the banking index has not performed since then. Our bank, you please check the shareholder report. We'll send you, since if you leave your details behind with us, we'll share with you exactly what the bank index has moved, how much our share price has moved, and how much our book value per share has moved. Our book value per share has moved up only 20% in 5 years. That is after the initial collapse that happened up to 31 and now up to 53. It has now gone up by 20%. All other banks have gone up by 100%, meaning the book value per share. Now, if we have grown by percent, I'm not saying it's a great job. It's not that, but I'm just saying this was just an issue. Whether whoever is there in the chair, this would have been the situation because it's a past issue. So, for example, if one bank share price was quoting 400, today it's quoting 25, then it is not because of this management. Someone else has gone and done whatever they've done. So we got to benchmark somebody from where they take over a position and then move the stock, measure benchmark from there.
Thank you, sir. Our next question is from the line of Aditya Shah from Vikram Advisory Services. Please go ahead.
First of all, I would...
One more thing, just to the previous comment, just to tell you, just to finish that answer. Therefore, we have done our best. The bank has made tremendous progress. Otherwise, the book value of shareholder could not have been 51 today after the situation we were in. But let me just say that we got to look ahead. I am not in the business of looking backwards. This was given for context since you raised a particular number. When we look ahead, we believe that, this bank at this stage is posting a 10% return on equity on a more normalized basis. Now, 10 has to move to 12, 12 has to move to 14, 14 has to move to 16. Let me tell you a bit about what the underlying prospect of this bank is. Now, I leave it to you as a shareholder for you to assess this and get the confidence, and I request for your confidence. What is it? Now, end of the day, the bank is borrowing money at 6.3%. We have brought down the cost of funds from 7.8% to 6.3% in this 5 years. And we are raising 55,000 crores of money with just 1,000 branches. We're raising 55,000 crores at 6.3%. I would request you to note that this is really good by any bank standards of the country today. Now, we're raising money at 6.3. We're lending. We're getting a NIM of 6.3. Now, this is a 5-year-old bank. Now, for a 6.3 NIM, even if you add about 1.5, 1.6% as fees, so that makes it about 6.3, 7.3, about 7.8. Now, this cost-income ratio is about 71% today. In due course, this is at a 5-year bank, but in due course, when you take a 5 years, 6 years, 7 years forward, or maybe longer, this cost-income ratio will touch 50%. That's the way, end of the day, even Capital First is running at only 48%. And we have done that. So it will come to 50. So then that would be the, operating profit of the bank could be that 8 minus 50%, like something like 4%. Even if the credit cost is 1.3% of assets, that would mean a pretty strong return on assets for the bank. So fundamentally, long run bank is structured superbly in terms of brand plus incremental economics. Now, things do come, regulatory changes do come. Even now, we have given a guidance for 5 years, but we're always watching out for market changes, guidance changes, regulation, etc. Please consider those risks also when you're investing in the bank. But this is the early stage, but I think the long term of the bank is really, really very, very good.
Thank you, sir. I request Mr. Aditya to